Welcome to Taxed and Confused, the podcast where tax administration meets real talk. We are your hosts, Lizzie and Lisa, two tax nerds on a mission to decode the rules, demystify the system, and maybe even make you laugh along the way. From tax returns to objections and everything in between, we're diving into the world where the burden of proof is on you, not the ATO. That's right, this isn't criminal law. In tax, you're guilty until proven compliant. But just a quick heads up, this podcast is for educational purposes only. It's not tax advice, and it's definitely not a substitute for professional guidance tailored to your situation. So brace for bureaucracy and join us as we explore the weird, the wonky, and the wildly important world of tax admin, because when it comes to tax, we're all a little taxed and confused. So Lisa, we have a case edition here today. We're continuing our exploration of the ATO payment regime, taking a closer look at the debt relief in the context of serious hardship. In doing so, we are exploring the case of Alexander, which is a decision handed down by the Administrative Review Tribunal in 2025. In this case, the taxpayer sought relief from a tax debt of about $73,000 on the basis of serious hardship. The ATO refused the request, and the taxpayer applied to the tribunal for review of that refusal.
And it was no deal. No deal.
So before we jump into the details of the facts of the case, just reflecting back on our last episode, we broke down the ATO payment regime and the capacity for a taxpayer to apply for a payment plan or a deferral of debt. However, some circumstances mean that a taxpayer may not be in a position to pay the tax debt at all. So does this mean the ATO needs the discretion to set aside its statutory obligation to pursue the recovery of tax debt, despite these debts being a Commonwealth debt?
Well, yeah, they sort of do, don't they? And that's what happens. So we're basically looking at the difference between paying and capacity to pay, isn't it, sort of thing? It's sort of like, how far does it go before you have no capacity to pay now? Right? So the big difference is what we were talking about. I think about it like businesses. So businesses and individuals, are you going to be able to get yourself out of trouble? Is it short-term cash flow issues and things like that? Well, therefore, payment plans, you've got to pay. And we know what happens as well, because if it's a company, you've got directors. If the company doesn't pay, we're going to go after the directors with a DPN and things like that, director penalty notice. Where the difference of what we're talking about now is saying, well, are you stuffed? Really, is the client really gone? It's like, it's not how to pay, it's like whether you actually can pay.
Yeah.
So the difference I look at from what we talked about last time to now is sort of, this is business related, where this last time it was business related, where this is really about the individual, right? Because the ATO can't leave the individual, my dad would say on the susso, like, out on the streets, in the homeless shelters. That's not what they do. If it's all to do with tax debt, what's going on. So it's last time it was like how to pay, where this time we're talking about whether you've got the capacity to pay. That's how I think about it.
Yeah. And so we had Practice Statement Law Administration, PSLA 2011/14, which looked at the broad principles of tax debt collection. In this episode, we're looking a little bit closely at PSLA 2011/17, if I can get that out.
Yes.
So, and that covers specifically tax debt relief, waiver, and non-pursuit. Correct. So, can you clarify a little bit further the difference between the two PSLAs here?
Yeah, so they're both PSLAs, so they're both the rules that the ATO will follow for a request for managing your debt collection versus relief from your debt collection. So that's what we're talking about. And as I said, it's the difference between how are you going to pay it, because you're going to eventually pay it. We just need to give you more time, and whether you can pay it. And again, today we're talking about wavering for individuals more than businesses, because businesses have got different dynamics with that. And we're talking about now the release of the debt. So it can be from a non-economic to pursue, which is really at the lap of the ATO, or a complete release of the debt in total, where they're opposed to, we'll give you more time to pay it. If you want to put it into housing terms, is the bank going to come and take your house like the ATO is going to, or are you just going to go, oh, we'll just defer it, like during COVID. So are you going to give time to do it? And so with what we talked last time and the other PSLA, it's sort of like, yeah, we'll give you as much time as you can to manage it, to get out of your financial difficulties. So it's a temporary cash flow relief. Where with the non-economic to pursue and the wavering, we're talking about, let's just put it on hold until your situation completely changes, or let's just kill it completely. And the difference being as well, which is quite interesting, is that with any sort of payment plans, the GIC, right, the general interest charge is continuing to accrue, right? And we're still going to have to pay it. But with the non-economic to pursue, or the whole writing off of the debt, or the GIC doesn't accrue then, all right? So if the non-economic pursue just eliminates from your account, but it's still sitting there in the background, you're not paying any GIC on it. It's basically, it's sort of in a off the books sort of account, if we can put it that way. All right, as well. So there's sort of the two differences that we're looking at. And with this PSLA, they've really separated out the non-economic to pursue bit, which is really at the discretion of the ATO. And then can you actually eliminate the debt completely? And sometimes the finance minister even has the right to do that. Like we've been, thinking about the right for someone to be granted a visa, like's been going on here as well. Does the minister get involved? And the minister can waiver the debts as well. In those
that last
cases.
Resort.
But it's
and that's
really,
where the debt is actually on.
I find this one as being really, really more about the individual.
Yeah.
Right.
Yeah. Yeah. So we've got this PSLA. It covers issues like debts that are not economically worthy of pursuing, that they're irrecoverable at law, but in particular, the issue of cases where there's serious hardship. So let's take a look at serious financial hardship. What are we actually meaning by this? Because it's not defined within the legislation. Really, it's something that's been explored by the courts, and the PSLA provides a perspective on that.
Well, yeah, it's sort of like it can it. Well, I mean, I'm just having a look at the PSLA about the non-legally recoverable bit, Lizzie, and we're sort of talking about, it's acted by the court. It's acted by the court. Someone's gone bankrupt. Those sort of. I'm looking at, there's a deed or arrangement. There's some sort of, to me, my interpretation is it's that legality outside of the tax system that says, we're not going to collect because you can't pay any of your bills, in effect. Is that how you sort of think about it as well? Yeah,
that non-economic to pursue and the irrecoverable law. Yeah, they're looking at very particular circumstances, and the PSLA provides a number of examples of what that covers. So when we get to the financial hardship or the serious financial hardship, we're looking essentially at when that person, that individual, it has no longer the ability to afford the basics, so food, clothing, those medical supplies, accommodation, and reasonable education elements there. And so
but it can't be at the discretion, Lizzie, and that's what it is. It can't be at the discretion. It's sort of like the basics, but you can't go on a holiday to Disneyland. That sort of thing is what we're talking about. So it's are you going to not have any quality of life is what I sort of think about when that serious hardship clause comes in, which is totally different to me, the non-economic to pursue, because to me that's from the POV of the point of view of the ATO going, it's $100, we'll just write it off because, or it's someone that now lives overseas, and we know, to me, that sort of parallels like our withholding system for non-residents. Why do we have a withholding system for, dividend, interest and royalties? Because there's small amounts and it's putting the responsibility back there.
Yeah. So, and those can be those, if they're not economical to pursue at this point, doesn't mean they're not going to be economically able to be pursued later. And there's certainly been some media around those debts resurfacing in recent times, hasn't there?
Absolutely. With the new Commissioner of Tax, he's very much taking a public servant aspect to it all. The previous commissioner was a tax person from a Big Four firm, so that was more the tax bias. Where now it's like the current commissioner is saying, let's collect things, let's have a look at, there's so much debt owed to the ATO, what can we recover, what can we collect in any shape or form. I'm getting phone calls for clients that owe $2,000, $5,000. It's just sitting there in the account, and it's mainly that they haven't thought about paying it. They've just gone, oh, sorry, Lisa, I forgot to do that, right? But, someone who owes $100,000, are they chasing that up? Because that's in a much bigger ballpark. But the non-economic pursuit stories, I've had clients where it's as small as $300 from 10 years or 15 years ago that's now appearing, on their account. There's no GIC on it, but they've still got to pay it. So I'm just getting them to pay it when we do their next tax return. But then I've got another story about a friend of mine who's got a client, and they thought it was actually completely waived, but of course it was just non-economic pursuit, and it's now refreshed at $30,000. So that's really serious, Lizzie, with what's going on. But it's again how the mechanism goes with your discussions with the ATO, and that's why tax administration is so important. I was just doing another presentation just before, and I said 80% of my job is all on admin and managing clients. The sexy tax is like 20% of my day, if that.
Yeah. And so those kind of establish those non-economic perspectives, but the commissioner has a number of tests it applies when it looks to the serious financial hardship perspective, the income and outgoings test, the asset and liabilities test, and other relevant factors test. And really that's examining the person's capacity, so the taxpayer's capacity to, meet tax liabilities based on their income. It looks to, do they have access to assets? Again, looking to the ability to sell, to be able to cover those assets. And then the other factors that might come into play are a little bit interesting. And one in particular is in relation to whether it's the taxpayer's activities or actions that have actually placed them in a position of hardship when it comes to that. So there's a lot of other factors that can come into play. And that's coming into play
with the Anderson case, the Alexander case that we're going to talk about as well. It's an interesting scenario. But it's interesting because our last podcast, our last episode and this episode, there's a lot of similarities with it. Like you're talking about those things, and I'm going, that's exactly the same if I want to set up a payment plan for my client. They look at capacity to pay.
Past history of compliance.
All
Have
that
they
sort
otherwise
of stuff.
been a good complier? Are they, what are they doing with the other debts and liabilities and their intentions around meeting, or are they going on holidays, or are they paying off, putting money into super and that, what are they actually doing? Are they actually taking seriously a Commonwealth debt that they actually have to pay? So that probably feeds in nicely to actually start looking at the case as part of this case edition. So Alexander, as I said already, was held in the Administrative Review Tribunal in 2025, and it was a circumstance where the taxpayer had claimed or requested a relief from the tax debt due to serious financial hardship. Did you want to run through some of the basic facts?
Yeah, why not? Let me do that. I've just pulled them up so I can remember. And I like it because it's Elwood, so it's in Melbourne. I always like it when I read tax cases and we can put it all together. So Ms. Alexander, she lived in Elwood and she decided to subdivide her property, which is pretty common, It's you going to build in the backyard. So she decided that she'd sell one of them, which was her main residence, and then rent the other one out. And then she lived in the property for about 15 years. So she finally sold the property in 2021, and she thought the main residence would apply. But of course, she rented out, she sold one that was a main residence, then she rented it out and then moved into the one that was the rental, Lizzie. So, you've got to apportion things. But she just thought, main residence on everything. She probably listened to some Fin influencer like we know, right? And go, yeah, it's all good, right?
Yeah.
So
we
with the
potentially
money,
are extrapolating the facts there. So we'll put in the show notes the links to the case summary if you want to find out the particular details there.
no, that's actually what happened.
Oh, really?
She should have been apportioned main residence,
Yep,
okay?
yep.
I don't know
Yep.
what she did with we do know what she did with the money, okay? But so what she did, and it's all in the case, right? So with the money, she didn't think she'd have to pay any tax on it because she thought both houses would be covered under the main residence exemption instead of a partial, and that's where she got herself into a bit of a pickle. Okay, so she cleared the mortgage and then she put the remainder into super, as you would do, because she was getting a little bit older, right? But after discussions with her tax agent, she realised that she only had the partial main residence. So again, it's another example where your client comes to you after the fact, Lizzie, which is really, really, really common. Okay, they go, oh, I thought it was just no, it's partial. So the capital gains tax ended up being around about 190K. And that was her tax debt that she said at the start of the episode, about 73K, right?
And noted, it's interesting actually here that the taxpayer hasn't debated, they haven't objected against the assessment regarding the CGT that's payable here. So the tax obligation here itself is not under question. It's more the ability to pay that debt.
So think about how it came about, Lizzie. It's just basically poor tax planning. Right. And myself being a practitioner, it's always that. The number of times I'll have a client that'll come to me and go, oh, Lisa, I bought a property. I'm going, which entity did you buy it in? It's that sort of question.
Yeah. So, and we've got to reflect on the self-assessment regime that we have here. The onus is on the taxpayer. It's on that individual to get their tax right. And there are the tax agents out there, registered tax agents that are there to support, to make sure you do the right thing. And that can be challenging and not everyone gets it right. And so in this instance, while the CGT, perhaps the event itself was understood, but the tax implications were not well understood by the taxpayer here. But again, there wasn't interestingly, there wasn't a question over tax avoidance here. This was not a question that there was tax avoidance, that there was penalties and interest on that. This was simply the fact that there was a CGT debt.
Yeah, and she'd already put the money in places, right? Clearing the mortgage and putting money into super. Now, she was getting towards retirement age, so it was going to impact all, this CGT event, of course, as we know, statutory income. It's going to include an assessable income. So it's going to impact her SAPTO, right? Medicare levy surcharge. Right, so it's going to have a big impact on it all. So she sought relief under Section 340 sub 1, Schedule 1 of the 53 Admin Act, right? Her other income was an age pension and she had account-based pension. Her assets were a car, a bank account, and about 400K in super. And she, lived a pretty modest lifestyle.
Yeah, she didn't have much. I think her car was valued at about $8,000. I think she had about $3,000 or $4,000 in the bank. I think her net spend each week just off living, I think it only was about $40 surplus every week or so. So I mean, she was living, fairly minimally.
Absolutely. So she applied to have the debt for debt relief. And it was refused on primary 2 grounds, the ATO said, right? Pay other creditors instead of making payments towards her tax debt. And she structured her affairs to place herself in a position of hardship because she put money into super. That's how I was reading it. So the ATO then looked at the 3-tiered test in the PSLA that we were talking about, 2011-17. So they looked at the 3 things you just mentioned: income and outgoings, assets and liabilities, and other relevant factors. So the surplus income wasn't much. It was like, well, I've got it down as nearly $30 a fortnight, which was insufficient to pay, $27.92. And this is all in the case, so we can read it in the public domain. Despite owning her home debt-free, she satisfied no other borrowing capacity in terms of asset and liabilities. So she was okay on those 2 grounds. They basically said, yep, income and outgoings, yep, you haven't got much money to left at the end, and there's no way you can borrow money against what you've got to satisfy even, something like a $70,000 tax debt. But the other factors was where the ATO said, no, you failed those, because she put solar panels on her roof and she had credit card repayments as well, right? And she structured her affairs by putting the amount into superannuation as well. So those two factors, even though they were good things to do, but remember, a superannuation is a tax minimisation vehicle, yep, funding her retirement so she's not going to be relying on the pension, but still it's a tax minimisation vehicle. So the solar panels was not helpful in terms of meeting those debts, and also the super. So the ATO's decision was basically granting the release of the tax debt would put her an advantage over more compliant taxpayers. So if she didn't have those two things, she would have the money to pay her tax debt.
Yeah. And the tribunal was pretty clear on the fact that the taxpayer here could access the superannuation because of their age and their circumstances. They could actually arrange a periodic income or a lump sum to draw upon to cover the debt. And whilst that then has an impact on future retirement plans, they do have the capacity. So from that point of view, the tribunal made specific note that that they couldn't make the conclusion that the taxpayer would be suffering serious hardship through having to pay that tax debt. And so that was a big factor. I noticed that the tribunal did reflect on the ATO's position on the likes of those credit cards, the solar, and they found that they weren't very neither here nor there, but it was that super in particular that could be drawn upon and really kind of created seemed to create a line in the sand for the taxpayer. It was interesting though, that to highlight that you need to look at the causal relationship between the potential tax debt being paid and the hardship being experienced. So would this taxpayer suffer serious financial hardship if they had to pay this tax debt? And that is something that we assess at the moment that decision is being made. And at that moment, that super could be accessed. And so in that respect, that's it, the decision is there.
Exactly, Lizzie. I mean, it's the timing. That's what I thought was very interesting about this case, because it wasn't the time that the tax liability arose, it was the time of the decision. And because when she had the tax debt, I don't think she could access her super because she didn't have a condition of release. But by the time the decision was made, she could. And that's where it's really important to look at how the timing as well. What do we say in tax all the time? It's also the timing. Dates are so important. So the timing of that test was so important to this case.
Yeah, and it was actually interesting because the tribunal did flag the future circumstances of the taxpayer may change and mean a relief option could become available. And part of that is also that if the tribunal had found that there was serious financial hardship to pay that debt, the next question is, well, what should the actual relief be? So should it be, to what extent should relief be provided? So there's a couple of steps involved in making that assessment, even if you did pass that kind of first hurdle in establishing financial hardship. But the other the other point that I thought was worth raising is the relevance here of the PSLA. So we talk about the PSLA being the guidance for the ATO here, but the tribunal itself is not bound by the content of that guidance. So it's the
No.
ATO's structure, and it creates consistency across how it's going to treat these applications. It provides explanation of how a decision is made, but ultimately, the tribunal is assessing that financial hardship, and so we do need to be careful of the overlap or the relevance of the PSLA once we hit that tribunal
Exactly. And
consideration.
exactly, Lizzie. And that's the point. The reason I think some of the frustrations people get with the ATO is the lack of consistency, right? When we talk about applying remission of GIC and things like that, it's the lack of consistency. And these PSLAs are the guidelines, right? They're the rules. But again, the ART, I think it was ART, not AAT, could be AAT. I can't remember.
ART.
It was ART. I wasn't sure.
Yeah.
I knew it was around about the time they changed over. They're not bound for it because they're looking at the law, right? And the interpretation of the law.
Yeah.
And it comes down to what we've always talked about the guidance from the ATO. What protects you? What doesn't protect you? And remember, it's always guidance, right? Even you can go against a tax ruling. You think about Bendel, for example. You can go against a tax ruling, but you know it's going to go up through the courts, right? So you've got to take the risk of doing that. But with most of the other guidance that comes out, it's just helpful, right? And again, how deep are your pockets?
Yeah,
you know?
yeah. Because it costs the taxpayer here money to attend and have their position reviewed by the tribunal. It's not free here, and particularly when you've already got a circumstance of potential financial hardship. To what extent is even this kind of review possible to many in facing difficult circumstances?
And that's
It's a
all with our
catch-22.
law. Yeah, it's all with our law, isn't it? When we teach, as we know, we basically go, are you going to go to court for $100 deduction? You're not, right? So again, if the ATO push back, well, you're going to go, okay, I'll have to capitulate because you've got deeper pockets than me. So I'm just going to do that. So again, we've got to understand what the dilemmas are that we've got to face, and it's got to be economical.
Yeah, the passage of time. By the time, was it the 2022 tax return that this CGT event, or 22?
Yeah, I can't remember which one it was now. It was around that time.
And so we're now in 2025 when the tribunal is deciding. So that's a number of years where there's this $73,000 debt being up in the air.
And it's got GIC accruing. It's got GIC accruing as well. So, and actually that's pretty quick, because my rule of thumb when I look at tax, this is ART, so it's not the court system, but I'm looking at 7 or 8 years. Normally there's about 7 or 8 years between the income tax year and the year of the court case. I was teaching this week Carden's case, right? And Carden's, I always like Carden's case, it's not called Carden's case, but we'll just call it Carden's case. But I'm looking and going, Carden's case was decided in 1938. And I said to my students, I said, why is this a South Australian case and not a federal case, right? And they go, what do you mean, Lisa? And I said, well, I've taught you this. You should be able to answer that question to make you think, right? And when you've got to go back and look at the year that the Carden case was in, right? Not the year. So it's the income year that the law applies to, not the year of the case. And I just thought even that, every time, even we teach the basics, Lizzie, I get a light bulb moment and go, isn't that a good learning experience for it? And it's the same sort of thing that we talk about. You've got to understand the rules of the game you're playing in.
Totally. That's a really good point. I was going to ask, what's your overall message to listeners that you should take from the position on hardship, probably to just bring it back one final time before we wrap up?
Yeah, I think that, well, you've got to know, as I said, you've got to know the rules. Look at the PSLA and see what it is, right? And I don't mind asking, you're better to, sometimes you're better to ask. So even remission of GIC or anything like that. So my take home is ask, otherwise you're not going to get it. But and it's always reward for effort. And that's sort of where you were getting to as well. Like, how much work does Ms. Alexander want to do to try and save herself 70K worth of tax plus GIC that's accruing at roughly 10% compounding for those years?
Yeah.
Right.
Yeah.
And then how much work does she need to do? If she's got no paperwork, her income, expenses, assets, liabilities is not going to get her there. Right. So, and then just talk to people, work it out to see if it's worth it to do it. So ask, but this case is not going to go any further because it's going to get more expensive to go up through the court system. And they've already said that the serious hardship is because she put some money into super, she put some solar panels on, which were nice to have, even though we think it's a good thing to do, and she can pull the money out of super. So we're saying, well, you can pull the money out to pay your tax debt, but it might put you in serious hardship down the line. Where's the balance for that?
Yeah, and it's perhaps also if you're undertaking significant transactions or events, or the tax practitioners are out there that have the expertise to help in those instances. So making sure that you make use of a registered tax practitioner if you need support, or if you're suffering serious financial hardship. There are also other support mechanisms like tax clinics that run through universities that do provide support to those that are in vulnerable circumstances.
Especially when it comes up, domestic violence, coercive control, and those sort of things. There's a lot of things around those aspects that would fit into that other category.
Yeah, and it often steps away from the actual tax, but to the tax admin issues that follow on, and the challenges around that. So the administrative elements and clinics around Australia can be supportive of that. Yeah, all right. Well, that's it for this episode of Taxed and Confused, where the rules are rigid, the paperwork is endless, and the burden of proof is all yours. If you enjoyed today's deep dive into tax admin, don't forget to subscribe, leave a review, and share it with someone who's just as confused as we are. And remember, this podcast is for education, entertainment purposes only. It's not tax advice, and we're not your tax agents. Thanks for listening, and until next time, stay curious, stay compliant, and stay just a little bit taxed and confused.